Stellantis formed in 2021 through the merger of Fiat Chrysler Automobiles and the French PSA Group. This union created the world's fourth largest automaker by volume, boasting a portfolio of 14 brands including Jeep, Dodge, Ram, Chrysler, Fiat, Peugeot, and Citroën. The company's recent announcement to slash production by 200,000 vehicles and a dramatic drop in profit margin forecast from 11.4% to 7% signal deeper problems within the organization. These developments have sparked concerns among industry analysts and investors about the company's immediate future. The automaker's troubles stem from multiple factors, including mounting dealer complaints, inventory management issues, and declining market share across key regions. Their decision to maintain higher prices on several models has backfired, leading to unsold vehicles piling up at dealerships and forcing increased promotional spending. In this video, we'll explore the key issues behind Stellantis' current situation and discuss what this means for the future of Stellantis. In a surprising move, Stellantis has significantly scaled back its profit expectations for 2024. The company's adjusted operating income margin, previously forecast in the double digits, has been slashed to a mere 5.5% to 7%. This dramatic shift stems from lower production levels and reduced shipments in the second half of 2024, significantly impacting the company's working capital. Investor confidence has been particularly shaken, with many questioning the company's management decisions. Barclays has downgraded the stock to equal weight from overweight and slashed their 2024 to 26 operating profit estimates by a staggering 33 to 45%. The situation has become so concerning that investors are now worried about the future of Stellantis' generous shareholder returns. The company faces a complex challenge in managing its diverse portfolio. The situation is particularly worse for American heritage brands like Chrysler and Dodge, which are struggling with aging product lineups and declining market relevance. The lack of new products has become a critical issue. Chrysler hasn't launched a completely new vehicle since the 2017 Pacifica, while Dodge is in the midst of a challenging transition from its beloved muscle cars to electric vehicles. This stagnation has led to a significant loss of market position, with Stellantis falling behind Hyundai Motor in U.S. market rankings. The once proud Chrysler brand has hit rock bottom, with sales plummeting by an astounding 59% to just 10,371 vehicles, merely a third of what it moved 5 years ago. The situation isn't better across other brands. Pacifica minivan sales declined 63% to 8,356 units. Dodge sales declined 8% to 42,514 vehicles. Despite a 51% increase, Fiat only managed to sell 178 vehicles. Tavares declared bluntly to reporters, "If they don't make money, we'll shut them down," marking a significant departure from his previous stance of protecting all brands. The situation has become so concerning that even Frank B. Rhodes Jr., the great-grandson of Chrysler's founder, has stepped forward with a proposal to purchase and revitalize the struggling American brand, Chrysler. The reality is stark. Stellantis can't afford to maintain underperforming brands indefinitely. Mounting inventory challenges have forced Stellantis to take drastic measures in its North American operations. As dealer lots overflow with unsold vehicles and sales continue to lag behind expectations. The automaker has announced a dramatic production slowdown, with plans to slash output by more than 200,000 vehicles in the second half of 2024 compared to the previous year. In North America, shipments declined by approximately 170,000 units. Stellantis has accelerated its inventory normalization plans, setting an ambitious target of no more than 330,000 units in U.S. dealer inventory by the end of 2024. Despite their preference for production cuts, Stellantis hasn't completely avoided the incentives game. The Ram brand has seen a remarkable 35 to 40% increase in sales during October, primarily driven by aggressive marketing and incentive programs. This surge comes as the company expands its truck production capabilities, with plans to produce Ram 1500 trucks at their Saltillo, Mexico facility next year. The pricing strategy has become particularly challenging in North America, where industry-wide negative pricing trends are emerging. Stellantis' specific inventory reduction initiatives, pushing their North American pricing several points below industry trends. This has been especially evident in their approach to 2024 and older model year vehicles, where increased promotional spending has become necessary to move excess inventory. The company's dealers have been vocal about the need for even more aggressive incentives, particularly after witnessing a 20% decline in third-quarter sales despite the existing promotional efforts. This balancing act between production cuts and incentives highlights the complex challenges Stellantis faces in managing its inventory while maintaining profitability. The global automotive landscape has become increasingly challenging for Stellantis, with the company facing headwinds across multiple international markets. Europe, traditionally a stronghold for Stellantis, has become a significant source of concern. The company recorded a staggering 25% decline in new car registrations across Europe in September 2024, while maintaining its position as the second-largest automaker in Europe with a 17.6% market share. Stellantis has struggled to defend its territory against newcomers. Brand-specific performance has been equally troubling, with Fiat registrations plunging by 43%, Citroën by 41%. Despite these challenges, there's a silver lining in the battery electric vehicle segment, which saw a 14% increase in September registrations, totaling 212,197 units. In a move to address its market share in China, Stellantis has committed a substantial €1.5 billion investment in Chinese EV startup Leapmotor. This partnership aims to leverage Leapmotor's cost-efficient EV ecosystem and boost sales in China, the world's largest automotive market. However, Stellantis' previous ventures in China have faced challenges, including the recent bankruptcy of their joint venture with Guangzhou Automobile Company for Jeep production. The situation is particularly concerning in the electric vehicle space, where Chinese manufacturers are offering competitive products at lower price points, even after accounting for higher tariffs and logistics costs. The competitive pressure has forced Stellantis to reassess its global strategy, particularly in the electric vehicle segment. While the company has seen some success with models like the Peugeot E208, the best-selling EV in France, the overall market response to their electric offerings has been tepid compared to competitors. The road ahead looks bumpy for this automotive powerhouse as it battles multiple fronts simultaneously. Their aggressive inventory reduction target of 330,000 units by year-end might help stabilize operations, but it won't address fundamental issues like aging product lineups and growing competition from Asian manufacturers. Market data suggests Stellantis must make tough choices about its 14-brand portfolio while accelerating its electric vehicle strategy to stay competitive. The company's ability to navigate these challenges will likely determine whether it maintains its position as a major global automaker or faces a significant downsizing in the years ahead. So I hope you guys enjoy this video. Leave your thoughts in the comments section below. Hit the subscribe button and like this video for more such content.